On January 1st, something that looks administrative on paper is being treated like a hard switch by the people who actually move metal, because when a supply chain is already tight, permission becomes more valuable than inventory. In the same breath, trading desks are whispering the same number, $17 billion, not as a headline, but as a collateral figure, a survival figure, the kind of number that appears when paper exposure collides with physical limits. And the uncomfortable part is that none of this requires a public crisis to be real, because the most dangerous breaks in a financial system start as quiet shortages in the things nobody thought could become strategic. Price discovery just changed rooms. Liquidity is losing its footing. The repricing is already underway. Not by a dramatic ban, not by a viral headline, not by a single shock event, but by turning silver into a controlled outflow, a form of silent repricing deployed slowly enough to avoid panic and strongly enough to change the system's real value before the public notices. The mistake is thinking silver is a niche metal that only matters to stackers and speculators. In modern supply chains, silver is a conductor, a contact point, a paste, a thin layer of certainty inside devices that pretend to be digital and weightless. It sits inside solar, electronics, medical components, industrial controls, and the boring infrastructure that keeps everything else from failing. When silver is cheap, nobody cares. When it becomes hard to source in size, everyone cares at the same time, and the system learns what small market actually means. Because silver is not traded like wheat or oil. It's traded like confidence. The futures market is the loud layer, the visible layer, the layer with charts and commentary. Under it is the quiet layer, bars that have to be refined to spec, shipped, assayed, insured, allocated, and delivered slow, physical, stubborn. The loud layer can expand infinitely. The quiet layer cannot. And whenever those two layers drift too far apart, the spread doesn't just close. It snaps. This is where China matters, even if you ignore every headline and every argument about motives. China sits in the middle of industrial gravity. Not merely as a producer or consumer in one clean statistic, but as a place where refining capacity, fabrication demand, state priorities, and administrative control can be aligned in days, not quarters. In the West, markets are managed with words. In China, markets can be managed with gates, licenses, approvals, inspections, customs friction. Quiet constraints that never sound like a ban until the day you try to move size and realize you can't. A system can survive volatility. What it cannot survive is a sudden change in deliverability. That is the plug concept, not a cinematic shutdown. A narrowing of exits, a tightening of flow. A shift from available at a price to available only with permission. The metal doesn't vanish. It just stops showing up where the paper contracts assumed it would. And when that happens, every synthetic position that relied on frictionless sourcing starts to feel heavier, like a backpack filling with wet sand. This is why the number matters. 17 billion doesn't need to be perfectly confirmed to be meaningful, because the shape of it is the story. Margin, variation, collateral calls, emergency funding, and the quiet scramble for cash that happens when a position is still hedged, on paper, but suddenly unhedgeable in the real world. People hear margin call and imagine a retail account getting wiped. That is not the important version. The important version is a large institution being forced to post more collateral today, not because it is insolvent, but because the market is no longer willing to accept its assumptions about access and delivery. That is how stress shows up in 2025, not as a single bank failure at 9 a.m., not as a televised bailout, but as funding pressure that moves through plumbing, credit lines pulled, repo rates spiking in corners, dealers widening spreads, risk committees tightening limits, and everyone pretending it's normal because saying it out loud would make it worse. Here's the reversal that people miss. The more financialized a commodity becomes, the more fragile it gets when it returns to being a commodity. Paper markets create the illusion of infinite flexibility. Physical markets enforce finite reality. And when reality walks back into the room, the paper doesn't politely adjust. It panics. Silver is especially designed for this kind of panic because the market is relatively small compared to the size of global balance sheets that touch it. Indirectly through derivatives, through structured hedges, through complex positions that net to safe until they don't, the exposure is not always a directional bet like the internet imagines. Sometimes it's market making. Sometimes it's client flow. Sometimes it's hedging for industrial users. But the result is the same when the physical constraint bites. Everybody needs the same thing at the same time. And the system suddenly discovers what a bottleneck costs. And that cost is not only a higher spot price, it's a higher price for certainty. Watch the behavior, not the narrative. When a market gets unstable, the first thing that happens is not a crash. The first thing that happens is a change in terms. Delivery windows get flexible. Premiums rise in specific venues. Lease rates and borrowing costs quietly stiffen. The spread between places that can source metal and places that can only promise metal starts to widen. It looks like a technical detail. It is not. It's the market telling you which layer is real. This is why China pulled the plug, lands like a shock inside bank risk models, because a model can price volatility. A model can price correlation. A model can even price geopolitical risk in a vague way. What it struggles to price is administrative friction that becomes strategic. A licensing rule does not look like a weapon until you see what it does to the time dimension, how long it takes to get metal out, how uncertain that timeline becomes, how quickly inventory gets trapped, and how fast everyone else starts bidding for what's already outside the gate. And once that starts, it's not just silver anymore, it's credibility. Because the global financial system still depends on the assumption that commodities are interchangeable across regions with minimal friction, that arbitrage keeps prices aligned, that if Shanghai trades higher than New York metal will flow until the spread closes, that the world price is real. That assumption is the backbone of countless trades that have nothing to do with silver in a direct sense. It's the quiet promise that the world is one market. When that promise breaks, even in one metal, it creates a template. It tells every serious player the same thing: regional control is back and physical goods are drifting toward political gravity. So the real question is not whether silver hits a dramatic number, because price is the last thing the public notices and the first thing professionals adapt to. The real issue is what happens when a strategic node decides that outflows will be managed, not market cleared. That's when the market stops being a market and starts being a negotiation. A negotiation has winners. A negotiation has losers. A negotiation has timelines and leverage points and sudden calls that have to be answered in cash. That is why banks would fight over 17 billion like it's oxygen. Because in a collateral-driven world, cash is not just money. Cash is time. And time is the only thing a leveraged structure can't manufacture. The sequence is always the same, even if the headlines change. First, the physical layer tightens. Then the spreads widen. Then the paper layer tries to bully the physical layer back into place. Then the funding layer starts screaming. And only after that does the public get a simple story, usually the wrong one. This is not about a metal becoming popular. It's about a system discovering a constraint it forgot it had. And once the system discovers a constraint, it does not go back to sleep. It adapts. It builds workarounds. It creates new pricing lanes. It shifts settlement habits. It rewrites what liquid means. The metal becomes a signal, and the signal spreads. Because a controlled outflow is not just a commodity policy. It is a message about power. It says, access can be priced, permission can be priced, stability can be rented. And if you want certainty, you will pay for it, quietly, continuously, and in ways that don't look like inflation until your input costs never come back down. That's why January 1st matters even before anything happens. When professionals change posture ahead of a date, the date is already working. The trigger is not the announcement. The trigger is the repositioning. The public will look for a bang. The system will move with a whisper. And the next move is the one that makes the silver story stop being about silver. The cleanest way to understand what is happening is to stop treating it like a silver story and start treating it like a replay of what markets always do when the physical layer refuses to obey the paper layer. You've seen this pattern before, just with different assets and different excuses. When the London gold pool cracked in the late 1960s, it wasn't because people suddenly loved gold more. It was because the promise to supply at a managed price couldn't survive real demand. When the Hunt Brothers silver episode detonated in 1980, the lesson wasn't speculators are dangerous. The lesson was that exchanges will change the rules the moment deliverability threatens the system. When nickel broke in 2022 and the market was effectively rewritten overnight, the public learned a rare truth. When physical stress gets extreme, the market becomes a decision. What matters is that these moments don't begin with panic, they begin with friction. The first stage is always subtle. Paper keeps trading. Headlines stay boring. But physical terms start changing in places most people never look. Delivery windows stretch. Premiums rise in specific hubs. Borrowing metal becomes harder. The spread between I can settle you in cash and I can actually deliver the metal widens quietly day after day. And then one morning, everyone notices at the same time because somebody large fails to roll a position the way they always have. That's why an administrative shift out of China can behave like a hard switch without ever looking like a ban. A customs delay is invisible until it hits the calendar of an industrial buyer. A licensing change looks like paperwork until it turns into a queue. And a queue is a hidden tax on everyone who needs the metal now, not later. If you control the gate, you control the timing. If you control the timing, you control the price of certainty. The silent signals were already stacked before January 1st. You don't need one giant smoking gun. You need 3 small anomalies that suddenly rhyme. First, local premiums in Asia behaving like they're pricing scarcity, not convenience. Second, inventory behavior that feels defensive, more metal staying close to home, less metal casually flowing to close arbitrage gaps. Third, financing terms shifting in the background. Not dramatic enough to trend on social media, but sharp enough to show up inside risk models and treasury desks. When those 3 align, it creates the same message every time. The market is paying up for immediate, verified metal and discounting anything that relies on smooth logistics. You can see it in how participants start talking without saying it. They stop discussing spot price and start discussing availability. They stop arguing about charts and start asking about lots, brands, assay, and location. They start caring whether a bar is already in the right form factor, in the right warehouse network, under the right jurisdiction. Because in a stressed market, jurisdiction is part of the commodity. And that's where the global layer comes in, because this isn't happening in a vacuum. The world is splitting into pricing lanes. BRICS isn't just a political acronym. It's an emerging habit of settlement, trade routing, and reserve preference that reduces reliance on one financial center. Europe is trapped between energy costs, industrial policy, and security dependence, which pushes it towards strategic stockpiling and tighter control over critical inputs. Central banks, meanwhile, have been telegraphing the same instinct for years: accumulate assets that don't carry someone else as liability, and reduce exposure to assumptions that require perfect trust. Gold has been the obvious beneficiary of that instinct, but silver is the more volatile sensor because it sits at the intersection of monetary history and industrial necessity. It doesn't need to replace gold to become disruptive. It only needs to become hard to source at scale at the exact moment the energy transition keeps increasing baseline demand. This is where the small market trap becomes lethal for big balance sheets. Silver is not large enough to absorb unlimited paper positioning without consequences, yet it is important enough that industrial users can't simply walk away from it. If supply tightens and demand stays sticky, the adjustment doesn't happen politely through a modest price rise. It happens through a violent repricing of the time dimension. Near-term delivery becomes expensive. Forward promises become suspect, and anyone short physical access starts paying a penalty that compounds. So when you hear that banks are fighting over something like $17 billion, don't imagine a single dramatic wager. Think of an ecosystem under stress: market makers who have to post more margin as volatility rises, hedges that stop behaving because basis risk explodes, funding desks that suddenly demand higher quality collateral, and internal limits that tighten at the worst possible moment. In that environment, cash is not just cash. Cash is the ability to stay in the game long enough for the next roll date. It's oxygen. This is also why the market reaction shows up first in positioning, not in headlines. Institutions start avoiding long-duration promises. You see preference shift towards short-term paper, short-term hedges, short-dated funding, anything that reduces exposure to a future they can't model. In commodities, that translates into reluctance to write long-dated supply at fixed terms. In rates, it shows up as investors hugging the front end. In credit, it shows up as spread sensitivity that feels too jumpy for the public narrative. And the public narrative will always lag because it has to stay simple. The deeper issue is that no policymaker can fix a physical bottleneck on demand. You can't cut interest rates and produce more refined silver next month. You can't raise taxes and conjure new mines into existence. You can't print your way into more throughput capacity without time, equipment, and stable energy inputs. In other words, there is no policy lever that creates metal. There are only levers that decide who gets it first and who pays more for it. When systems run out of clean choices, they default to the same move: reallocation through price and control. That's true in Beijing, and it's true in Washington. In the West, debt loads make aggressive austerity politically radioactive and sustained high rates financially corrosive. In China, growth, stability, employment, and strategic industry priorities constrain what can be allowed to leave the system freely. Different constraints, same behavior. Manage the flow, manage the optics, and let repricing happen in a way that doesn't look like a crisis. And markets front-run that behavior. They always do. Once participants believe the gate is tightening, they stop assuming arbitrage will rescue them. They stop assuming a temporary spread will close naturally. They start acting as if regional shortages can persist. That alone changes the structure of pricing, because it turns a global commodity into a semi-local one, and semi-local commodities trade with fear premiums. Not emotional fear, structural fear. The fear that I will not be able to replace this position when I need to. That fear is what breaks paper illusions. Because the moment physical access is questioned, every claim on silver is no longer equal. A futures contract, an unallocated account, a promise and a prospectus, those instruments may still have legal value, but they do not have identical utility. Utility is what the market reprices first. And that repricing is exactly what produces collateral fights, emergency liquidity demands, and sudden policy adjustments that are always framed as prudent risk management. At that point, the market is already reacting ahead of the public. Funds rotate. Hedgers shorten tenors. Dealers widen spreads. Industrial buyers lock supply earlier and pay up for guaranteed delivery. Weak hands liquidate because financing costs rise. Strong hands accumulate because they understand the constraint is not sentiment-based. And then you get the final stage. The system pretends it has options, but it doesn't. Supply can't be expanded quickly. Demand is anchored by industrial need. Policymakers won't allow an uncontrolled panic. So the only path left is controlled repricing, slow enough to avoid mass alarm, strong enough to reset who holds the advantage. This is not a rumor-driven circus. It's a mechanical sequence. If you want the forward-looking implication, it's this. When a market learns that strategic choke points can be activated quietly, it begins to price the next choke point before it happens. That's how a localized move becomes a global template. And templates don't stay contained. They propagate into other metals, other inputs, other settlement systems, and eventually into the way capital treats risk-free assumptions. The silver story is just the early sensor. The deeper story is that the world is drifting toward controlled flows and segmented pricing, and financial structures built for frictionless global liquidity will have to adapt, whether they admit it or not. What's happening here isn't a dramatic China versus the world storyline, and it isn't even primarily a story about silver as a trade. It's a story about how modern markets behave when a physical input becomes political. Because the moment export flow is governed by permission instead of price, the commodity stops being global and starts being segmented. On the surface, you'll still see a spot quote and a futures curve and people arguing about charts. Under the surface, the market begins pricing a new variable that never shows up on a retail screen: jurisdiction. Here's the real mechanism, and it's simpler than it sounds. Silver has two prices at the same time. The first is the public price paper contracts, futures, ETFs, synthetic exposure. The second is the private price, the cost to secure specific bars, in a specific form, in a specific location, with delivery certainty. Most of the time, those two prices track closely enough that nobody cares. But when flow is constrained, the private price detaches first, and it drags the public price behind it like an anchor. Export licensing is not a ban. It's a throttle. It doesn't need to eliminate supply to break the structure. It only needs to inject uncertainty into timing. Timing is everything when you're running industrial procurement, when you're rolling hedges, when you're short physical access and long paper substitutes. If you can't predict when metal leaves a country, you can't confidently arbitrage. If you can't arbitrage, regional premiums persist. If regional premiums persist, the idea of a single world price becomes more like a suggestion than a rule. That's why the days leading into January 1st matter. The date itself is just a marker that tells every serious participant to re-rate risk before they reforce to. And that re-rating doesn't show up as one clean move. It shows up as a cascade: higher lease rates, wider spreads, tighter credit terms, rising margins, and sudden demand for collateral, because banks and brokers don't get to say, "We'll figure it out later." They get daily marks, daily funding costs, daily risk limits. When the market begins to doubt deliverability, it begins to doubt the balance sheets that intermediate deliverability. This is where the banks fight for $17 billion frame fits, even if you treat the exact figure as secondary. In stress, the system doesn't first run out of assets. It first runs out of clean collateral. And collateral scarcity is contagious because it forces selling in other places to raise cash, which increases volatility, which increases margin requirements, which increases the demand for collateral again. It's a loop. You don't need insolvency for the loop to hurt. You only need a market that stops trusting smooth settlement. Now zoom out, because the next layer is where this becomes unavoidable. The global system is already sliding into parallel lanes. One lane is the Western financial architecture built on deep capital markets and liquidity management. The other lane is a growing set of trade relationships that prioritize supply security, local settlement, and strategic stockpiling. You can call it BRICS or multipolarity or de-risking. The label doesn't matter. The behavior does. Countries and corporations are acting as if the cheapest source is not always the best source, because the cheapest source can become unavailable at the worst moment. When that mindset spreads, commodities stop being purely economic goods and start behaving like strategic inputs. Silver is a perfect stress test for that shift because it lives in both worlds at once. Historically, it carries monetary memory. Practically, it carries industrial necessity. That dual identity is why a flow control measure can have disproportionate impact. Industrial users can't boycott it easily, not without redesign and qualification cycles. Investors can't ignore it easily because the market is small enough that constraints bite fast. And intermediaries can't neutralize it easily because paper hedges are only as good as the physical layer they reference. First-order impact is what happens inside markets and supply chains before the public feels it. You get a rising premium on immediacy pay, more for metal that is already where you need it, discount promises that depend on smooth shipping. You get more backwardation events spot tighter than futures because the market is screaming that now is worth more than later. You get an incentive for hoarding, not as a meme, but as rational inventory defense. If you think replacement risk is rising, you hold more buffer stock. That reduces available float, which tightens the market further. And you get a change in hedging behavior. Industrial buyers shorten hedges because long-dated contracts start to feel like a bet on geopolitics, not just price. At the same time, you get credit reacting to commodities, not the other way around. Banks tighten limits on positions that rely on physical sourcing assumptions. Brokers raise margin requirements. Funding desks price more risk into anything that can gap. That's when the financial layer begins to amplify the physical layer, because every added turn of the funding screw forces someone to delever, and deleveraging is rarely orderly. This is unavoidable. Second-order impact is what happens when the price of a small metal becomes a quiet tax on big systems. Solar manufacturers feel it in input costs that don't show up in a consumer's monthly bill immediately but erode margins. Slow capacity expansion or force redesign trade-offs. Electronics feel it in component pricing, especially where silver is used in contacts and pastes that aren't easily substituted without performance loss. Supply chains feel it indirectly because high-volume manufacturing doesn't tolerate procurement uncertainty. It tolerates higher prices better than it tolerates missing parts. Even defense and data center buildouts feel it, because the same conductivity and reliability requirements keep pointing back to the same materials. And then it leaks into policy. Governments can announce targets, but they can't legislate deliverability. If the energy transition keeps compounding demand while flow controls and bottlenecks constrain supply, the real outcome is not a neat shortage headline. It's persistent cost pressure. It's schedule risk. It's a slower, more expensive rollout of everything that was assumed to be cheap and scalable. Now, in every system shift, there are winners and losers, and the pattern is cold. The winners are the entities closest to the physical layer with the least replacement risk. Producers with credible output and low political friction. Refiners with capacity and reliable feedstock. Industrial buyers with long-term contracts and strategic inventories. Warehousing and logistics networks positioned in jurisdictions that become trusted settlement zones. And yes, holders of fully allocated physical metal, because in a segmented market, optionality is a form of return. The biggest winner, though, is whoever can convert administrative control into pricing power without triggering public panic, because that is the definition of strategic leverage. The losers are the entities that monetize the assumption of frictionless flow. Short positions that were safe only because the market used to be liquid. Manufacturers optimized to run lean with minimal inventory buffers. Funds and desks that depend on rolling paper exposure without ever touching the metal. And banks that intermediate the whole structure. Because when the plumbing becomes the story, the plumbing gets blamed and regulated and forced to hold more capital against activities that used to look routine. Now lay a timeline over it, because this doesn't resolve in a week. Early 2026 is the phase of adjustment and forced discovery. Export licensing tightens timelines, premiums become the headline inside industry circles, and the market tests how much pain is required before supply reroutes. This is when you'll see sudden shifts in borrowing costs and margin policy because intermediaries respond faster than policymakers. Mid to late 2026 is the phase of adaptation and substitution attempts. Recycling ramps. Thrifting accelerates where possible. Manufacturers redesign around lower silver loadings in some applications, but not all. Meanwhile, the market creates new trusted channels, more bilateral contracts, more prepay structures, more direct sourcing. The public will call it stabilization. It's not. It's the system paying the price to rebuild certainty. 2027 is the phase of structural repricing. Not just higher prices, but different pricing. Separate lanes. Persistent regional spreads. A larger role for strategic stockpiles. More political language wrapped around supply security. And a new baseline where volatility is not an accident, but a feature of a world that stopped pretending commodities are purely economic goods. From the top-down view, this is the part most people miss. History doesn't repeat as a headline. It repeats as a reconfiguration of what markets are allowed to do. When the world shifts from price-only flow to permission-governed flow, it changes how capital measures risk, how industry builds resilience, and how nations interpret security. Silver is just one of the first places where that reconfiguration becomes visible, because it's small enough to stress quickly and important enough to matter. If you want to track this without noise, don't obsess over a single number on a chart. Watch the spreads. Watch lease rates. Watch backwardation. Watch regional premiums. Watch what changes in terms and availability before it changes in headlines. Those signals move first because the real market moves first. If you want the next signals early, stay close. Not for hype, just for timing. Because in a segmented world, timing is the edge, and the repricing always happens before the explanation.